Hello traders, this is an Informed Trades video introduction to price action trading. This video covers, first of all, what is price action trading, then the basics of reading charts, understanding support and resistance levels, basic setups and stop placement for them, and finally, two examples of trades from the Forex market. Okay, to begin with, what is price action? So, price action is a particular methodology used by traders based on observation and interpretation of price, usually through the use of candlestick or bar charts. This style of trading is usually characterized by clean charts without indicators, with the explanation that indicators are themselves interpretations of the historical movements of price. So they don't contain any information or predictive power that isn't available from the charts themselves. Nonetheless, some traders do include basic indicators such as exponential moving averages or average true range to augment their charts or to provide confluence. Since candlestick and bar charts are the fundamental interface of the price action trader, the most basic unit is the candle or bar itself. These candles sum up the price action over a set period of time. So on a 5-minute chart, each candle represents 5 minutes of price behavior, whereas on a daily chart, only one candle is produced per day. The body of the candle constitutes the range between the opening price and closing price, whereas the wicks or shadows of the candle indicate the high and low over that period of trading. Different color schemes are used to determine whether the price movement is bullish, increasing in price, or bearish, decreasing in price. Bullish candles are usually white, blue, or green, whereas bearish candles are black or red. Longer candle bodies demonstrate strong momentum and decisive market behavior in the movement from open to close. Longer shadows, however, demonstrate increased volatility since some prices were reached during the time period, but ultimately excluded from the range between open and close. Smaller candles can indicate the market's indecision, disinterest, or a balance between bullish and bearish forces. Similarly, a candle that is almost all wick implies that regardless of the range of prices occurring in the time period, the open and close were extremely close. These candles are referred to by the Japanese term doji. A doji, or a small candle with a very long wick in one direction, is referred to as a pin bar, which is often interpreted as a sign of potential trend reversal. By contrast, a Maribuzo candle has a large body and almost no wick, implying that price action has been more definitive over that time. There are two rudimentary patterns that play out over at least two candlesticks. An outside bar is a bar with a higher high and a lower low than the previous candlestick, often with a body that also encompasses the price range of the previous bar's body. And a variation is the engulfing bar, which just has a higher open and a higher close regardless of the relative size of the wicks. The other pattern is the inside bar, which is a bar or series of bars with a high and low encompassed by the preceding candle. In this case, the variation is the harami, a bar or a series of bars with an open and close within the range of the bar preceding it, rather than high and low. Alright, before we move on, I want to explain some basic terminology for price behavior. So a trend implies two successively higher tops and bottoms in the case of an uptrend, or two successively lower tops and bottoms in the case of a downtrend. The terms run up, bull run, and rally all correspond to an uptrend, whereas run down, bear run, and decline are just different ways of saying downtrend. When people say trading range, it implies that the market is moving up and down within a consistent range without establishing a definitive trend in one direction. Consolidation implies that the range of prices movement is constricting as the market becomes directionless or bears and bulls are balancing out. A reversal is a movement of the market in the opposite direction from the previous trend, and a reversal implies that that trend is over. So typically prices dip down to around the level where the trend began. Whereas in the case of a retrace, the market moves some amount in the opposite direction from the prevailing trend before the trend is eventually reinstated. Another popular concept is the two attempts rule, which is basically the idea that if the market tries to do something twice and fails both times, then the opposite will happen. So if the market is testing a new high and it tests this new high twice without breaking through after the second time, it may result in a dramatic fall in price. Alright, so support and resistance. In a trading range, or even within a trend, price action frequently seems influenced by or adherent to levels that have been previously significant turning points in the history of the market. On the price action traders' charts, these levels are marked as lines offering potential support and resistance to future price action. Lines drawn above the current price constitute resistance, while lines drawn below it are support. If one of these levels is broken by the movement of price, the function is reversed. So, for example, if price breaks through a resistance line, that line can now be understood as a support line to future price action. Support and resistance lines are typically horizontal, but when they are diagonal along a trend, they're known as trend lines. As an example of how to draw the horizontal lines, I marked some significant support and resistance levels on this chart of the Euro-US dollar pair. This lowest level at about 1.34 is established as the point where the initial trend in mid-September is arrested and turns briefly bearish. After the bullish bear tops out at this level, the two bearish bars thereafter max out as though they're experiencing resistance from the same level before there's a breakthrough on September 16th. At this point, the resistance line becomes support, and we can see that all the way 2 months later, in mid-November, this support level is tested and holds as price rises back up for the rest of the month. If you recall the two attempt rule that I explained, we can see that in action with this highest resistance level at about 1.383. We would draw this line in because it represents the height of the bullish trend extending from the beginning of the chart all the way to late October, this big trend. We can see that price returns closely to this level in the next trend peak in mid-December, and then finally tests it with the wick of this candle at the end of the month. Since the level is reached but price fails to definitively break through, we can expect a reversal based on the two attempt rule, and that's exactly what we've seen since the end of December. So the basic idea behind using support and resistance effectively in a trading range is to buy at the support level and sell at resistance in the case of an uptrend, or to sell at resistance and buy at support in a downtrend. So we're not necessarily hoping for a breakout through these established levels, because a breakout means that the market isn't behaving predictably enough to allow for safe bets on what's going to happen. So the more conservative or reliable trades are those that occur as the market fluctuates between identifiable support and resistance levels, allowing you in an uptrend to buy when there's a retracement, like a bearish leg, that's brought prices down to a support level, and then you sell when price returns to the resistance level, or conversely, in the case of a downtrend, you sell when price is maxed out at a reliable resistance level and buy when price falls down to support. The reason we're looking to buy in an uptrend and sell in a downtrend is that price action trading is all about playing the odds, so trading with the trend rather than against it is usually a better idea, since a trend is statistically more likely to continue than to reverse. Alright, now I want to cover basic setups and stop placement. So first of all, stop placement. Most price action traders buy or sell using stop orders with a predetermined stop loss level and a predetermined take profit or target level. The buy or sell stop sets the level that price has to reach in order for the order to be filled. The stop loss level sets the margin of loss that a trader will accept before the position is closed out, and the take profit level sets the level at which to automatically close a successful position. So basically you determine risk based on where you're placing your stop, and then you determine your target with regard to this risk level. A common ratio that traders aim for is 1 to 3 risk to reward, although scalpers and those who trade on shorter time frames often have to accept smaller ratios. The buy or sell stop, or entry level, is typically set at a significant support or resistance level so that it will only be filled when price has broken definitively in the desired direction. So by setting these entry levels strategically, traders can ensure that they enter trades along with the momentum of the market. Alright, so now getting into setups. So probably the most basic setup is the pin bar, which, if you remember, is a bar candle with an open and a close within the previous bar and a wick at least 3 times the length of the candle body, which in this wick protrudes beyond the preceding bars, so it's a new extreme. So the long wick and short body implies that traders have made a strong attempt to push price in one direction, but price has returned to the earlier levels. So often this indicates the possibility of a reversal in trend direction. The most basic way to trade a pin bar is to place the stop loss level at the extreme of the wick and to place your entry level above the body in a bullish scenario or below the body in a bearish scenario. The target is set relative to the risk level based on the stop loss, and the target is also often set at a resistance level in a bullish scenario or a support level in a bearish scenario, basically a recent swing high or swing low. Another basic strategy is the inside bar, which is, if you remember, a bar or series of bars contained by the preceding or mother bar. Since the shrinking candle size implies consolidation, it can mean that a big move is on the way, either a strong continuation of the current trend or a reversal. Because the price direction is uncertain, traders will often place orders on both sides of the inside bar so that a downward movement will trigger a sell, but at the same time an upward movement will trigger a buy. So a liberal entry point for the inside bar setup would be setting your buy stop or sell stop just beyond the high or low of the inside bar. And a more conservative entry point is setting them at the open or close of the preceding mother bar. In general, inside bars are more effective to trade on larger time charts like the daily charts because there are just so many inside bars on faster charts that it's harder to find a good signal. Alright, so to conclude, we have 2 actual orders from trader Simit Patel. The first is a pin bar style order placed on the Canadian dollar Swiss franc pair on January 6th to sell at 0.85341, the black line, with a stop loss level set at 0.85995, both of which you can see that are historical resistance levels. The take profit level is set at 0.823333. And we can see that later on in the same day of Simit's order, price reached his sell stop level at 0.85341 before dropping almost exactly to the target level of 0.823333. And this second trade is an inside bar style order placed on the Euro British Pound pair on December 12th. Simmet sets his sell stop order at the black line, 0.84026, and his stop loss at the red line, about 0.84750. And his target is all the way down at the green line at 0.80978. We can see that after his order was placed, price did reach his sell stop order just before a major reversal in price. Probably Simmet would be able to take profit when price starts to look bullish again. That's around 0.82800. Alright, this has been an introduction to price action trading. If you've got any questions or knowledge to share, come join us in our learning community at informedtrades.com. Thanks for watching, and good luck in your trading.